Bobby McCauley-Stacy. He comes to us with a lot of experience, both in being on a pension board, but also formerly a city commissioner, if I'm not mistaken. He is a new employee of our city clerk department, but he brings a lot of experience with him. So welcome aboard, Bobby. We're very excited to have your expertise join us. Pam, if you could please take the roll call.
Patricia?
Here.
Bill Collins?
Here.
Bobby Stacy?
Here.
Commissioner Williams? Curtis Arnold?
Here.
I'd ask for public comment, but there is no one in the room. Moving on, consent agenda, invoices from Burgess Chambers, 1 invoice from Sterling Capital, 2 invoices from Foster, 1 invoice from Sugarman, Susskind, Braswell, and Herrera, 4 invoices from Truist. We have Truist Bank trade form, revised election procedures. We have 2 new retirees, Robert Strong and Connie Detweiler. If I can have a motion to approve the consent agenda.
I so move.
And a second.
I'll second.
Thank you. Moving on, old business, none. New business, Blake, you're up. Sterling Capital quarterly report.
Good afternoon, everyone. And welcome, Bobby. Again, my name is Blake Mighton. Excuse me. I had the pleasure of working with you guys for several years, managing about 2/3 of the assets. It's kind of transitioned through the years a little bit. Come from the Heritage SunTrust organization, where I started back in the late 90s. And then as we've evolved and with the latest iteration and merger, we became Truist. And moved over to the institutional investment management subsidiary of Truist is Sterling Capital, and they were previously with the old BB&T bank. They were their institutional investment arm, if you will. So that's kind of sort of my background has always been on the institutional side and the investment management. So again, we manage about 60 to 65% of the assets. The remainder of the assets are actually managed by the board and through your consultant, Larry, at BCA. And those really kind of the history there is it evolved out of, at one point it was all with SunTrust way back in the day. And then as we sort of grew and expanded, there were products that we didn't have access to on the SunTrust platform. I'll let Larry talk to, so I'll try to concentrate on those pieces of the portfolio. There certainly was enough to talk about this quarter. If you go over to my material, the first section is just a refresher on who Sterling is. I won't go into a lot of detail there, but over on page 4, the asset allocation is sort of the summary of the market indices for the quarter and the various time periods. It was actually a pretty strong start. It was a very good January and February. As we began the year, the S&P was up almost 15% at one point. And then unfortunately in March, the banking situation that we were just speaking about sort of reared its head and the market pulled back pretty strong. But all in all, it was still a pretty good period. It was kind of a period because financials came into question and the value indices did so well in 2022 relative to the growth indices. Those were the ones that really got hardest hit. What we saw was kind of a reversal of that trend this quarter. If you look on page 4, the first one right there, the first index is the Russell 3000 or the broader benchmark. Good solid quarter, up about 7.18%. And we'll certainly take that. Looking at the growth versus value, though, you can see the clear leader was growth. Just looking at the Russell Top 200, that growth component was up a little more than 15.5 or 15.6%. And then the largest 200 value-oriented companies in the index were up a little less than 1% or 0.85. So again, what we saw was the banks really took a beating. Energy also traded off during the quarter, and that was very, very strong last year. Again, there was a lot of speculation, a lot of uncertainty with the war in Ukraine that sort of subsided a little bit. That's kind of become all back burner stuff, and energy prices have sort of stabilized at least for a while. So we see those underperform this quarter too. So it really was kind of a period where everything that didn't work last year kind of worked in spades in the U.S. market. The same is true with small and mid return for small cap value. Again, that was the worst performer in the U.S. Segments, and again, it's directly attributable to those smaller banks really taking the brunt of it. There's a very, very large piece of that index dedicated to financials. International also did pretty well, but I'll leave Larry to talk to that, but they're certainly starting to see that pick up a little bit too, and those are those MSCI World Indexes there at the bottom of that equity section. And then the other piece that we managed, thanks to some of the volatility we saw in March, bonds actually did pretty darn well. If you look, bonds, that Bloomberg Aggregate Index was up over 2.5% just for the month of March, and we were up just under 3% for the entire quarter. So we were kind of chugging along with a slight gain through January and February, but when uncertainty hit, what we saw was people went to the U.S. Treasury once again as a sort of a safe haven, and bonds did pretty well there. So again, pretty solid quarter from an absolute sense, and a really good start to our fiscal year. We'll see that here in a minute. Over on the next page, a little bit more detail on the growth and value in those sectors. I touched on most of it, but again, what we saw was really technology, consumer discretionary, and communication services were the best performers. Those growth-oriented sectors of the market did very, very well, and it was the healthcare, energy, and financials that were underwater year to date so far. Especially, you can see that in the very bottom graph there. Over on the next slide, just a snapshot of kind of our tactical allocation and any changes that we've made. Not a whole lot of changes here. We really do like the smaller caps a little bit. The valuations are pretty compelling there, and we're pretty neutral with respect to growth and value. And again, you'll see that relative to the asset allocation slides here in a moment. And then down on the bottom, fixed income. Right now, we did make two slight changes to the portfolio. They're not really reflected in the 3/31 market values that we're going to see because we implemented them the first week of April. But really, what we did was we had a slight overweight to the high yield or those lower quality corporate bonds. We unwound that allocation tactical strategy. They did very, very well in the first quarter, met our targets. So we eliminated that in favor of trying to get a little bit shorter with respect to our maturities. So we added a small allocation to short-term treasuries, just as sort of a parking spot. And it wasn't so much we love treasuries, it was really try to get a little bit shorter than our benchmark at this point. So the rest of this first section goes into a lot more detail. On the next couple of slides, we go, dissect all of the various, stuff that we're looking at and constituencies in our asset allocation modeling. Don't usually go into a lot of detail there unless there's any specific questions. Suffice it to say, as we look into our crystal ball right now, there's still some uncertainty. It's kind of one of these scenarios, and I've kidded the last few quarters. It feels like the old Paula Abdul song, 1 step forward, 2 steps back. Because it seems like every quarter we get off to a really good start for the first month, the first half of every quarter, and then we give it all back in the second half of the quarter. It's kind of what we saw this quarter again. But at least we're grinding a little bit higher. The one thing I can say with 100% certainty is we're a lot closer to the Fed pausing interest rates than we were a year ago. It could be as early, if you look at the market and the expectations is there's over 80% chance, 75-80% chance that they will pause at the next meeting in June. So again, that would stop their campaign of raising rates for the last 13 months. We talked about that 5% or 500 basis point increase over the last year is just unheard of. And we obviously felt the pain there on the fixed income side. So moving forward, we think again we could probably get at least some decent coupons out of the fixed income now that rates are higher, and it looks like the Fed won't be a headwind. They may even actually be a tailwind. As far as pausing now and maybe cutting later in the year, that should help that piece of the portfolio. So we're fairly optimistic with respect to the rest of this year. And as you'll see here in a minute in Larry's report, pretty good fiscal year going so far for the first 6 months anyhow. We'll knock wood and see if we can get it through the September finish line. But again, we're fairly optimistic that 2023 is moving in the right direction, and most of the pain has been priced in and already passed us. Before I skip gears and talk about performance in more detail, any questions or comments sort of on the bigger picture or our forecast or outlook? No? Okay. Then let's skip ahead to the next tab. And that's tab 3, starting on page 16. First report is a portfolio summary of the cash flows for the various time periods. We've got the month, quarter, fiscal year, and then the 1 year period since we transitioned over to Sterling. Good solid numbers there in dollar terms, but for the quarter we came in at about 18.4. We had net distributions of just about 381,000 there. And then when we add the income to the capital appreciation, just under $1 million there, or about 930 some odd thousand. So the portfolio was just under 19 million, or 18,920. And again, that's our piece of the portfolio, to be completely accurate. And then over on page 17, we can put some percentages to those dollars. That 913,000 or 30,000 for the quarter equates to about a 5% return, or 5.06. If we look at the table there in the middle, you'll see the portfolio was up about 1.94, slightly less than the benchmark for March, or the month to date. But for the quarter, basically right on top of it, 506 versus 515. And then for the fiscal year, up a little more than 10%, or 10.49 versus the target there at 10.15. So some slight outperformance there. And then again, it's still a short period of time, but for the 1 year since we transitioned over to Sterling, portfolio has outperformed by a little more than 1.5%, or at least our piece has. So good, solid relative outperformance, even though, again, it was a very challenging environment and we were underwater, and we don't like to see negative returns, but I certainly like to see less negative than our targets and our benchmarks. So down on the bottom, we break out both the equity and the fixed income pieces, and you'll see, especially for the 1 year period, both have outperformed, which again is very good to see that kind of firing on both pieces of the cylinder, both the equities and the fixed income are doing very well relative to their targets and peers. Over on the next slide is what I refer to as some of the geeky risk statistics up at the top. Again, these will be a lot more important, or a lot more relevant, I guess, is probably a better way of describing them, once we have a little bit more time. 1 year is not really enough time to grade anybody by, but we're certainly off to a pretty good start. If we look at some of the risk measurements, so we've got the return there, that's the outperformance relative to the benchmark, but both standard deviation and beta are a little bit less than our targets, so we're taking a little bit less risk. And that would make sense since we lost a little less in an off market. We've taken a little less risk, but also done a pretty good job of getting the upside and downside capture ratios the way we like to see them. We'd love to get as much as we can and lose as little as we can in those down markets, but we'll certainly take a little bit more in the ups than we get in the downs, and that's how we get to that slight outperformance. But again, it's just 1 year, so we'll continue to monitor that as we move forward. And then I'll finish up with there's asset allocation and a little bit more detailed performance on the rest of this section. As you can see, as I alluded to earlier, slightly overweight stocks versus our target. And again, that target is expressed in the investment policy, Bobby. So again, if you want to know how we're trying to manage the assets, again, a copy of that investment policy is a great place to start. But you'll see, again, slightly overweight stocks, which certainly helped, and then underweight fixed income as a consequence of that. Then a lot more detailed performance. We've got the asset class performance over on page 20, and then the individual names that we're utilizing in each of those classes on page 21 and 22. Again, one of the primary reasons we've done so well is large cap growth. Over on, I guess, on page 20, if you look at the third grouping there, large growth, versus the Russell Top 200 growth. Our manager has done extremely well. He was up a little more than 21% for the quarter, when the benchmark was up about 15, and then for the full 1 year, a slight gain of about 75 basis points, but when the rest of that universe, or that target, was off a little more than 11, almost 11.5%, so very solid outperformance from that piece is really one of the driving factors on why we've outperformed over the last year or so. But good solid performance from the rest of the portfolio as well, too. Over on 21 and 22, you can look at the individual names and strategies that we're utilizing in each of those asset classes. Again, very similar to the asset class returns we just looked at, but kind of take it down to the granular level on individual products that we use. We don't usually go into a lot of detail there unless there's any questions or comments. And then because we did transition from the Heritage SunTrust over to the new Sterling world, one of the things we wanted to make available to all of our longer-term clients, such as you all, is a look back at the historical linked performance, right? It makes a lot of sense. So it's great. I mean, I've had you for 20 years, but you're only showing me a 1 year number since you've been with Sterling. So over on the next tab on page 23, that first page of the appendix, what we've done is, again, link the longer-term returns relative to the benchmark, and you'll see, slight outperformance over every time period, really. So good, solid performance from that piece of the portfolio for really, 5, 7, 10 years. So with that, guys, that's really what I wanted to cover today. Again, pretty solid start. We're in pretty good shape. I'm not counting my chickens before they hatch. We've unfortunately been down this road too many times. So, but at least as we sit here at the halfway point, we have given a little bit back in April. I guess April plus May, we're probably pretty flat as we sit here today. So we're probably pretty close to these 331 numbers. So in pretty good shape. But again, our forecast going forward is fairly positive, but again, it's still going to be very, very dependent on Fed policy, what they do with interest rates, and then now we've got the added factor of, is there going to be another financial institution that comes into everyone's spotlights, and what kind of impact that could potentially have. We don't see that turning into a huge contagion at this point. We think it's really kind of isolated in 3 or 4 mismanaged opportunities. As we alluded to earlier, the one commonality with all 3 or 4 of the ones that have ultimately failed or gotten bailed out was they were A, mismanaged, and B, they had a very large portion of their assets that were not insured up to, they were over and above that $250,000 FDIC limit, so that kind of led to some of the runs and some of the panic that we saw.
I wished I had that problem.
What's that?
I wished I had that problem. Too much in the bank. It's not
Yes.
fully insured.
Yeah. I'm sorry. I'm going to have to pull it out because you're not insured. You only insure $250,000. I don't have that issue either. Not yet.
Wrong business.
Still working on it.
Hey, Blake, what do you think? We were just talking about this with what the feds rolled out on giving preference to people with bad credit scores for mortgage.
I have not
That's
read a lot
gonna
about that.
impact
My
the real
wife
estate.
brought it to my attention, I guess maybe like within the last week or 2.
Yep.
And I because we're being recorded, I can't tell you my exact response, but it was something along, get out of here. Yeah, you're crazy. Because that makes absolutely no sense to me whatsoever. But unfortunately, and again, this is not Sterling, this is just Blake talking now, this woke world, anything's possible. I mean, they could try to do it. Now, whether it gets passed, I don't think there's enough support for something along those lines, but I don't know, do they need enough support? Can they shove it down your throat? That sort of remains to be seen, but I find it pretty unlikely.
I
And
think it got passed.
It got passed.
It got passed, but whether, I think the next question is
Implemented
whether
or-
it'll get repealed down the road.
yeah, I mean,
But-
how fast does it get
Well, I hope
implemented? Do we
so.
see
We
it?
all do. It's crazy.
I don't
My
know.
daughter's a real estate agent, and she lost a sale because their credit score was too high, and the bank could not give them a mortgage because their credit score was too
It's
high.
kind of a repeat of 07, 08, where they're kind of forcing the banks to lend to people who can't pay them back.
Yeah.
And, pay the price down the road.
Yeah, and then they turn around and
But
make you
following
hold
on
more on your
banks that
balance
just
sheet
went
reserves.
under, you just like,
Seems like
seriously?
the timing could not be any worse, and then they're charging a fee if you do, even if you've got that 800 credit score. My understanding, and I could be wrong on this, but my understanding is if you get the mortgage, you will have a fee associated with your mortgage that helps offset the costs that they are going to incur for being forced to lend to lower credit people.
So that's how they essentially
It's
tax.
bass backwards. I mean, it's crazy.
Yeah,
You,
it makes
you
no
don't get
sense
rewarded.
whatsoever.
You pay a fee for a good credit score.
Because the whole financial crisis of 08 was
Doesn't it make you want to
predicated
be
on all those.
irresponsible for the first time
Well, I
ever?
worry about kids like in their 20s and they're seeing this and they think, well, why am I going to worry about my credit score? Why should I worry about cleaning up? And staying
Good
up,
point.
So
If it's only going to hurt you, right? That was the whole point
Yeah.
of getting good credit, was so I could borrow at a lower cost and save on auto loans, houses.
You get a
at
student
least.
loan, you pay for the house, and then you're done.
Yeah, you get the student loan, you default on it.
and now the
then
student
you
loans,
get your
yeah,
down
now the
payment on
student
the
loans
house.
are going to get,
Because
they're
now
trying to
you-
get
Bad
those
credit
paid
score.
Now
for.
you can get a good mortgage rate because your credit score is bad.
Let's just say it's about a year and 3-4 months before we can do something about that. And
Well, it
everybody
just seems like
show
they're
up in
throwing a lot of
November.
money.
Everybody show up in November and don't sell your house in the next year or so.
Some of it doesn't
Is that a
seem
Florida
to be
thing or
logical.
a national?
National,
Yeah.
national.
I'm gonna have to do a little bit more reading on that, Patricia, because I was like, nah, that makes no sense.
No, they
How
passed
could
it.
that pass?
It passed.
Passed.
How? Was it just the supermajority? Did you shove it down your throat?
It was a rider bill, so.
I think it was lopped into a bunch of
It was
other
just
stuff.
lopped in with a bunch of other stuff.
In the detail
Those
back on
probably
page
didn't even get
788.
much press, you know.
Yeah, 1,788. You
Exactly.
stopped reading at 1,500.
Yeah, paragraph 3 on page 1078.
Well, thank you guys very much.
Thank you, Blake. All right, next is the quarterly report from Burgess Chambers and Associates. Larry Cole.
All right, thank you. Good afternoon again, everyone. Bobby, welcome on board. Sounds like you've had some experience on the board, so you probably understand my role as the consultant. We don't actually manage the money. We help you manage the money, or help you find the people to manage the money and do the asset allocation kind of work and studies and a lot of stuff you don't see what we do behind the scenes in between quarters, you know. But we're monitoring the managers. In this case, it's a little different than some of the plans we work with that, you know, 2/3 of your assets or so are being managed by one entity, who then goes out and decides they don't have to use Sterling products, they're using other products too. So that's a little bit different than some of the plans. So we kind of monitor Sterling as, rather than looking at all the individual pieces and they chose this manager versus that manager in this space, we kind of just look at the space and say, all right, in mid-cap stocks, how you doing? You know, because they could also make a change during the year, and that one fund they have now may not be, you know, indicative of how they've done in the space. So our report looks, it has that in it where you'll see space. We do monitor every one of the funds too in terms of how they're doing, but that's their discretion. They'll decide when they're going to fire managers under their umbrella and switch or change mutual funds or whatever they want to do. And then we've got about 35% of the portfolio that we make recommendations to you on that are outside of that umbrella. So, you know, Euro Pacific International is a good example. Added that a few years ago. There's several funds, convertibles, some of the asset classes that they don't really have didn't have any expertise in at the time, or we think we can find better. So that's kind of the relationship we have here. So if you look at our book is for the total fund. We used to joke we'd bring cookies or cupcakes when we went over certain levels. Well, we've already had the $30 million cupcakes, and then it dropped back down. The good news is it's back up. So I probably should have stopped at Publix on the way in, so I apologize for that, because we went back over 30 again.
What are you hoping next quarter you won't have to bother?
No.
You're lucky
No,
Scott's not here.
No, I hope I'm having to bring, yeah, I'll stop at that butcher shop in Cocoa. Forget the name of
Butcher
that.
shop.
There's the butcher shop. I'll bring steaks, you know.
I'm vegan.
We get over 35. Oh, are you? Well, I'll get something for you. We'll figure it out.
We gotta go to the key lime place.
Yeah, can you eat
Oh,
key lime?
now you're talking.
Now we're talking. Forget the steaks then, all right. I'm with you there. So anyway, in our report, the first page, there's a market perspective. We generally just write a short piece on something that's going on in the industry that particular quarter, try not to make it too complicated. I actually wrote this back about the time that the banking crisis started happening, and we just went ahead and used it. I think I sent that letter out to you even several weeks ago, and the good news is you had very little exposure, but just tried to explain a little bit of what was going on, and Blake just covered it, and I couldn't agree with him more. If you really dig into it, the banks that have gone under or been taken over had unique characteristics to them. Either extremely poor management, but in most cases, or in a couple of the big cases, it was the percentage of depositors that had over $250,000 in there was extremely high. I think SVB was over 80% of their accounts were over $250,000. Had a lot of that joint venture money, venture capital money. So, you know, fewer accounts, but big balances. And then that just put them at risk. And then what was interesting, and this is where we get into politics too, you know, the administration was encouraging, and the FDIC and everybody was encouraging banks to buy long-term treasuries because long-term treasuries are safe. So part of their asset base to back up their deposits, which are their liabilities, right, was they'd buy these 30-year treasury bonds. Well, they're allowed to carry those, as I understand it, carry them at book value, so they look pretty healthy. Well, that's fine until you get a run on the bank and that book value turns into a market value because you got to sell them now. So the Fed raises rates 5 times during the year, those bonds drop 30% in value, and they've got to sell them at those levels instead of the other, and all of a sudden your balance sheet doesn't look as strong as you thought it was. What's really frustrating about SVB is that the Federal Reserve, didn't do their job. They didn't monitor what they should have been monitoring, and they admitted it. They came out and just flat out said, we didn't do our job. We should have done better. But that doesn't stop the administration from wanting to throw 100 more rules on the books. The reality is, if they followed the rules that were already on the books, they had no problem. So SVB was that problem. Signature Bank had a similar situation. A large percentage of their deposits over the limit. I think they also had quite a bit of crypto exposure that might have hurt them at that time. And so anyway, when you go through it, a lot of it is mismanagement and probably a little bit of greed in there. But you know, it's just what we were concerned about was, is this going to spread to the super regionals? You know, the Truists of the world, those banks. Well, if you look at the deposit base in Truist, you'll see a much different picture. Very broad and diversified depositor base, much less percentage of their assets over the $250,000 limit per account. And it would take not just a run on the bank, but you'd have to get a whole lot of different groups of people to run on the bank. Where, you know, the venture capital guys, one goes, they might all run there and take it out just like that. But so I think the odds of that are pretty slim. They do have exposure to long-term treasuries, about all the banks do. So if there was a run, they could run into a problem, but not to the extent that some of the other banks did. But I just think that I think they're kind of past it now. And I think the chance of a significant run on the banks there is on these super regionals is pretty slim. So, and that's not all in there, but anyway, that's what happened during the period. So, and even if there is, you have some exposure to financials, but I don't think you really have literally almost no exposure, I would say, to banks that we think are in any kind of problem, any kind of trouble. So that's good. Page 2 of the report just shows the market. Blake covered a little bit. It was actually a good quarter. This is the second good quarter in a row for the markets where things were up. That's good. There's still a lot of 2022 in the trailing one-year numbers, but at least on a fiscal year-to-date basis, you're off to a roaring start. Obviously, we all want to hold on to that and hope we can hang on to it through September. The only thing down was the commodities. International is on the next page, on the bottom of page 3 on the left. Really strong quarter. It's actually been 2 strong quarters for international. I think Euro-Pacific's up about 25% since October 1. So a lot of that had to do with the decline in the dollar, which when you translate the earnings from the foreign currency of the U.S., it was a big plus. That's been a drag for them for several years. So finally, we see international kind of at the top of the heap for at least a couple quarters here. So that's good to see. The big story for the year and for last year, obviously stocks went down big, but the big story was bonds. And you had a minus 14% bond market for the year. In this case, the trailing 12 months is minus 5, in the minus 4 or 5 range. And that's after having a nice quarter. So, you know, it's still some lag there from 22 dragging us down, but that was just unprecedented. And the Fed raising rates 5 times in less than a year, again, unprecedented. And if you look at it percentage-wise, that's basically it's kind of hard to figure a percent when you start with 0, but it went from 0 to 5 in no time. And I was actually, I think I've told you all this before, I was a bond manager back in the late 70s and early 80s, early in my career. And I thought that was the wildest bond market I'd ever see, because that was when prime rate went from 11 to 21 and back to 11 in a 12-month period of time. And we were running around with managing 100% government profit-sharing plans, government bond profit-sharing plans, and they were down 6 and 7%. Like, you go out to these participants, and we did meetings then with a lot of participants that are in the profit-sharing plan and had to explain interest rates are at 14%, but you lost 5. And it was kind of a hard explanation. So that's why I'm not managing bonds anymore. Little side note there. If you go to page 5, we did have one item that was a compliance issue that I think has corrected itself as we sit here today, but we'll keep a close eye on it. And if we have to make adjustments at the next meeting, we will. And that's down at the bottom, investments in equities within the 70% limit market. So our investment policy statement says we won't go over 70% at market. in equities, which also includes convertibles, by the way. And we were at 70.37. Well, we're down a little bit this quarter, so we should be already under that amount today. So I don't think we need to take any action. But if we come, if we get a nice run in the stock market between now and quarter end, we'll have to make some adjustments next quarter and just get it back in line. And we'll decide what we want to do then. But other than that, everything was in compliance. Everything looked good. There's some no's there, but those are performance related, not compliance related. So don't worry about those, because all in all, your performance has been pretty good. If you go to page 6, this is the first look at performance. This is on a net of fees basis. So this is net of all the mutual fund fees, management fees. And you can see for the quarter on the left, we actually made $1.5 million, paid out $433,000. It was a big distribution quarter, but made $1,537,000, and again put us back up over the 30 million level, which is good to see. And the total fund return for the quarter was 5.3. That's not annualized. That's an actual number for the quarter. Blake has promised he would annualize his return, but get him to sign off on that. But ahead of the target, the strategic model. And then the really good news there on the fiscal year to date is they're up over 11% fiscal year to date net of fees. So off to a great start for 2023 fiscal year. We want to hang into that. I want to point out something, and I know I'm rambling a little bit, but 3-year numbers, 11% a year. Think about what we've been through the last 3 years. There's actually been what I would call 3 black swan events, and black swan events are supposed to happen once every decade or something, not every 3 years. But you had COVID, big one, right? You then had the Ukraine-Russia situation, and then this quarter we had the banking crisis. And we still have 11% per year for the last 3 years. That to me seems crazy.
It's
crazy.
crazy.
That wasn't in my investments 101 back when I went to school. So some pretty good numbers. That 4 and 5 year numbers are dragged down a little bit there there were a couple bad years in some of those, but all in all, I think you've weathered some pretty rocky markets over the last 3 years. It hasn't been a smooth ride to get 11% per year, but we're there. So I don't know why that just hit me today. I hadn't even said that in other meetings. It just hit. We've had basically 3 black swan events in 3 years, and you've still got 11% per year return. So page 7 is the asset allocation. I got to point out something. That this chart's a little bit, it's a little misleading. If you add up large cap value, large cap growth, and the large cap core, we're actually at about 23% in large cap equities versus an overall target of 25%. We just didn't have a separate core allocation in the current investment policy. We just did it between growth and value. Well, your core is kind of split between growth and value, so you could almost just take that out and put it equally value and growth. But I'm going to take a look at the IPS and see if I need to maybe make some tweaks to it. It really won't make a big impact, but just so that these kind of charts don't look so out of whack, because you're really not out of whack to the overall target. Same mid cap and small cap. We are a little overweighted, and again, this is kind of Blake's discretion. He has all those categories under his umbrella, but he's at 14%, almost 15, 14.9, I think, total versus 10% target if you add the mid and the small cap together. So, and I wouldn't disagree with that, and it's their discretion, so it really doesn't matter if I disagree with it, but we kind of like that space too. The small and mid cap valuations are much cheaper than the large cap arena right now, and fairly attractive, so a little overweight there should pay off for us. Infrastructure those are stocks, but those are stocks that will benefit from infrastructure spending on a global basis. So companies that would benefit from government spending for bridges, tunnels, airports, toll roads, even utilities and water facilities, especially a lot of the international utilities are kind of monopolies, and they can raise their rates. They got it built in, inflation protection built into their rate structure. Things like that. They're typically more defensive, pay a higher dividend yield, but protect us better in down markets. And they've done their job. They've done it. I'll show you that in a minute. But you have 2 managers in that space, and they've done their job. Convertibles are also a little bit, at least historically, a little bit more defensive. Those are bonds that are convertible into shares of common stock. They have the defensive feature of worst case scenario, you get the bond rate. It's a little lower than the market rate, but it's still, you get your money unless there's a default. But they also participate maybe 70, 75% in the upside of the stock typically. So I like the risk-reward characteristics of convertibles. I've used them for 25 years, and I just like the asset class, and it's served us pretty well. International, as I said, has done very good. Real estate, there's a little bit of concern right now with the direct real estate, which is your PREDEX fund. I'm not going to recommend we do anything because it's very well diversified. We're a little bit below the target anyway. That PREDEX is a fund of funds, so you have additional, not only what I want to say, not only diversification by property type, but diversification by managers managing those property types. So you got good diversification in there, probably weather the storm better than most funds. Real estate, commercial real estate right now is under a lot of pressure, particularly office space. The post-COVID world is showing that they're not coming back. And New York, I think I saw a number where New York, not necessarily in your funds, but New York overall office space is only about 47% occupancy right now. That's crazy. Now, most of the
is that
funds,
pretty much throughout the U.S., do you
I think it is in the major cities, yep. The major cities because of the crime, particularly it's crime. I think New York's is driven a lot by crime right now. It's not so much
People are
COVID.
afraid to leave their houses.
Well, most of them come in on the subway, and the subways have had their problems, you know, with different crimes. And so you're seeing restaurants moving out. Like, I just saw, it was a really interesting story, but a lot of the, like, a couple of the famous restaurants, I don't remember the name of them, but famous restaurants in New York are moving out to the suburbs because there's nobody coming to lunch anymore in the downtown area.
And I read, gosh, I forgot the source of this article, but I read an article recently that there are some restaurants that are they're going to stop providing any seating, that they're delivery only. You can pick up or they'll deliver, like they'll do the DoorDash or Uber or something like that, but they don't want you dining in.
Yeah.
Because they pay less in taxes, they need less space, and
the people aren't coming anyway, you know, because they're
yeah.
they might get
You don't
mugged on
need
the way there or
servers.
something, I guess, you know.
yeah.
So we're keeping a close eye on that. I will tell you that the managers within the PREDEX fund, and I forget how many there are, but these managers like J.P. Morgan, UBS, there's a lot of big players out there in these commercial real estate funds, and their occupancy rates aren't that low in the office space. It's more in the 80% range. But you know, just a year ago, it was still up in the low 90s, but those leases ran off, is what it is. You know, the occupancy was quote low 90s, but that doesn't mean 90% of the people were there. That just meant they were still obligated to pay for that space. And so those leases run off, then the true picture is starting to show. But most of those properties that in the actively managed funds are, you know, Class A, high quality properties that still have tenants paying the leases, and so it hadn't dropped quite as bad as the overall number I just shared with you, like below 50%. But you know, it's something we're keeping an eye on. Apartments have sort of propped that up a little bit. You know, multifamily has done well. Industrial space, warehouse space and all has done pretty well, although that's starting to show some cracks in the armor because it got a little overbuilt during COVID. You know, if you drive I-4 between Orlando and Tampa, you'll see, you know, warehouse after warehouse after warehouse that's popped up, and even Amazon overbuilt and started renting some of their space out to other providers. But online shopping's here to stay, and so a lot of retailers are still demanding, you know, they have to have more space. So, but it's something that's starting to show a few little cracks. But so we'll keep an eye on the space and keep you informed of how it's progressing. But you know, it's been negative so far, fiscal year to date.
And what percentage of it drop do you think it's time to evaluate and move?
What percentage?
Yeah.
It kind of depends on. I mean, if you mean at what percentage occupancy rate or what percentage of the fund?
Occupancy rate.
Occupancy rate. In our funds, it depends on the managers, because in that PREDEX fund, let's take J.P. Morgan as an example, because I just had a meeting with a client that has them direct. J.P. Morgan has reduced their office space from, I think it was 37% 18 months ago down to 21% now. And the 21% they have, their occupancy rate is still mid-80s. So the valuations have been hit some, but not dramatically. So it kind of depends on the managers, and that's why I say in this PREDEX fund, it's a fund of funds. So they're one of them, but you have a lot of other managers. So if, I don't know, I think it's probably close to a bottom because you're starting to see a lot of CEOs try to encourage their people to get back. So maybe it'll start creeping up a little bit from here rather than continue the downward slide. But we'll just have to keep an eye on it. I don't have a number in my head, Bobby, that says, if it gets to 40, we're going to blow out or something. But it kind of depends. Occupancy rate could go to 30, but your holdings could go down to 10. You may already, and I may not do anything then. So got a little bit of cash. So if you had the cash and the fixed income, we're almost at target there. We're about 29%, a little over. So I'm not recommending any rebalancing. I guess I could have summed that one up a little quicker. And then your returns on page 10, as I said, we go into the different categories to kind of monitor what areas are working well. Interesting on your quarter, out of all those categories, there's only 2 that underperformed the benchmark, if I did my math right. Large cap value was a little bit under, and mid cap was a little bit under. Everything else, that's a pretty good batting average. All the other categories were ahead of their benchmarks, so kudos. I think one of the best moves Blake made here recently was making the change in the large cap growth manager. That was probably a little over a year ago that you actually made the manager change.
It was right out of year.
Yeah, and that one's worked out extremely well, and that was a good move. So as you can see, international's up 25% fiscal year to date. So a lot of the asset classes that struggled in 2022 are the ones leading the pack now. So that's why you're pretty well diversified, because we don't know when that's going to happen, those rotations. And then I think maybe the last chart I'll cover with you is on page 16. Those are your fiscal year returns dating back to 2005. So as you can see, 21 and 22 were the most volatile 2-year period we've seen ever. That's almost a 40% swing in the returns in a 2-year period of time. Makes 2008 and 2009 pale by comparison, 2007, 2008. So, but the good news is patience, I guess, maybe has paid off. You're back up 11.5% so far in the first 6 months of this year. So I'd like to see that trend continue. I'm not quite as optimistic that it will with everything kind of, the debt ceiling issue is big. I think they'll get it resolved. The markets think they're going to get it resolved. They started settling down a little bit. But, if we default, that would not give some great buying opportunities, but it'll look ugly for a little while. But all eyes on the Fed, kind of waiting to see what they do. If they do stop raising rates or indicate that they're going to stop raising rates, you'd probably get a nice pop in the stock market, particularly in tech stocks. So I think we're allocated the way we ought to be for the long term, and you might have to just go for a wild ride in the short run. Never know. But Blake's portfolios are, kudos to Sterling on that. Most of their funds are performing pretty well, and then the ones outside now are, like I said, there's only 2 funds, not 2 categories, didn't beat their benchmark. So pretty solid. Any questions?
Thank you.
All right, thanks.
Okay. Next is a valuation report from Foster & Foster to be presented by Doug Lozen. Are you there, Doug?
All righty. Yeah, am I still coming through?
Yep.
Okay, this won't take long unless there's questions. I'll cover the funding requirements for the city, why they changed, and I'll give you an idea of where I think the city's requirement might be going over the next couple of years, and then an update on your funded status.
Perfect.
The contribution requirement did go up a bit for the current year, and the requirement from the city is about 6.4% of payroll. My calculation is in dollar terms, that should be pretty close to what the city put in fiscal 22. The city's requirement in 22 is about $470,000 or so. So for the current year, no real change. For budgeting for 23-24, that's the first year that we're recognizing the investment loss from fiscal 22. And the reason I say the first year is because we use a 4-year smoothing average for determining funding requirements. So while the plan did realize about a minus 19% when the assumption was 7.25%, the 4-year average came in at about 3%. So that dampens the increase to the city because of the smoothing. So budgeting, the city should think about 9.2% of payroll for next fiscal year. And another reason the requirement went up from 6.4 to 9.2 or so is that we saw that there were some pretty large salary increases compared to the assumption. I'm glad I heard confirmation on that. Sometimes I get people scratching their heads, but I've seen salary increases around the state this last year for a lot of obvious reasons, not the least of which is inflation, and then the minimum wage law increasing to 15 an hour. So that had another component to the city's increase, our large salary increases. Where I think the city's requirement might go once we fully phase in the fiscal 22 loss is maybe up to, around 15% of payroll or so. It's a guess right now because, some of the future's unknown. We know some of the past, but we don't know any of the future yet. It just depends on your experience going forward.
Doug?
Yes.
Yeah, this is Patricia. So you're at this moment in time, your tentative projection for the 25-26 budget or the 24-25 budget will be closer to that 15% mark?
I actually think it'll be more for the 26-27.
26-27, all right.
Yeah, I think it'll actually be fairly stable the next couple of years.
So for the
because of the way the smoothing works.
So for the 23-24, 24-25, 25-26, you think it's going to remain around that 9 to 10, but that in the 26-27 it's going to hit 15?
Yeah, I think so. It might go between 9 and 12 the next 2 or 3 years.
All right.
Kind of a slow increase, but there'll be a spike in the 26-27 year, I believe.
All right.
For funding. And the reason for the spike is you had a very strange back-to-back. Everybody did. Fiscal 21 was a tremendous positive return, 21%, followed immediately 12 months later by a minus 19. And because we use an average, a 4-year phase-in, both of those years are part of the average right now. But there will be one final year when the 21 is fully recognized, that gain, but we have one more year of the 22 loss to phase in.
Yeah.
And it's that valuation that you'll see, I think, a pretty big spike. But right now, my best guess is, about 15% of payroll when it's all done.
Got it.
So, we'll get you an update in your funded status. So the good news is the funded status is still very high. The plan's always been, that 95 to 100% funded, for at least the last decade. It did fall a bit. It was 101 last year. And with this report, it's 95.4. So still a very solid funded status. It might fall into the upper 80s as we phase in fully the fiscal 22 loss, but that's not a concern of mine. That funded status is still very high, and the way you keep that going is just with extra cash from the city, obviously.
So as long as we're doing the 9.2 contribution, we're going to stay above that 90% funded?
Yeah,
Or you
I
think
think
it's
the
gonna
next couple
drop?
of years. Yeah, I think you're gonna stay in the 90s the next 2 to 3 years, and I think you might fall into the upper 80s before it's done, and then it'll start climbing again from there.
All right.
So I'll finish off at that. I don't have any recommendations for any assumption changes. We just went through our full experience study less than 2 years ago, and we only do that about every 5 years. So I'm fine with all of your assumptions right now, and that's the update. Happy to answer any questions.
No, other than what I think that answered mine. Anybody else? Bill?
No.
Mr. Arnold? Okay, well, I'm happy that we had the smoothing with the 21 gains. Not as excited about the 22 losses showing up, but
Yeah, understood.
If we get another 21% return this year, though, that'd be helpful, right?
that would help.
Yeah.
That would help drop
Yeah,
that
well,
15%.
The news you got today is helpful too. I think if I heard right, you're already above your assumption for the year. I know it's only May, but that's
Doug, don't say that out loud. They have a habit of blowing it up at the end.
September.
Okay, retract that. Don't put that in the minutes.
Take that off the record.
Okay. All right, well, we'll make sure we hit that 9.2. Any other changes, anything else that we need to be aware of on here?
No. I've covered everything. Once you're good with the report, you will need to formally approve it by a vote from the board.
Well, then I'll just do that right now. Can I have a motion from the board to approve our actual valuation report as of October 1st, 2022?
Motion.
Second?
Second.
Thank you very much. Motion has been approved. Okay, thank you very much, Doug. Next thing on the agenda is informational items. It says BCA, understanding the current bank crisis. I think we covered that.
That was the letter I sent out, which is the market perspective
Yeah.
this quarter, so.
Okay.
Yeah.
Our next quarterly meeting is August 17th, 2023. Briefly, before we adjourn, I just want to mention to the board that there was a former employee that was over-dispensed on not a vested employee and received more funds than was paid in. That employee, we worked with Foster & Foster to get a contractual agreement for repayment. The first payment the former employee made was $5,000 towards that balance. So I'm not sure. I'll have to reach out to either Truist or Foster & Foster to see if they've made their May payment, but they did make a substantial pay down on that. It was over $13,000.
What are we doing this secret?
It was just over $13,000 that was overpaid.
What are we doing to make that from that?
I can't, I don't know that I can really speak to that because this was an anomaly situation, as they all are. So the processes that are in place is somebody in the HR department will review the employee. They go to the Foster & Foster website. They look at all the contributions that have been reported. They bring that to me for review and I sign off, and then we process that refund. This was an employee which, much to my disappointment, actually formerly worked for me in my department, bypassed the whole process because they knew how. Reached out directly to Truist for payment of the pension paid in. that was significantly greater than what they actually paid in. Nobody in HR, nor I, yeah. And it was during the annual process where Foster & Foster is reviewing all the accounts and getting the actuarial reports put together that they said, this is not right. And then that's when we had to reach out to the employee.
That was a policy.
Yeah, the employee left about 14, 15 months ago, and it was in December-ish when Foster & Foster were working on their annual reports for us that they found the
I
issue.
remember.
So way to go, Foster.